my time, think it's my year. Yeah.
Good morning, everybody. Welcome to the morning show. Hope your Wednesday's off to a great start. I'm Spencer Israel here with Steve Strazza and JC Parets. What's going on today across Wall Street? Let's see. We have a bit of a disaster earnings report from Advanced Auto Parts. We'll talk about that. We're going to talk about the tech stocks continuing to rally, sector rotation. Warren Buffett bought more Oxy. That's what he does, apparently. We'll be joined by Mike Singleton at 9 o'clock. He's a senior analyst at Invictus Research. Kimmy Sokoloff, our resident day trader, at 9:15. And that's the agenda for the day. So smash that like button. Let's get the show on the road here.
Hey, good morning. Trend lines over headlines. Strazza repping the chart report gear. I like it. That's dope. I don't think I even have one of those. Those are nice.
Well, I have like 50. So
there was a box full of them sitting right next to you all week.
You get a t-shirt. You get a t-shirt. You get a t-shirt.
Basically, yeah.
I like these.
Next time I see you, JC, I'm going to give you that box. All right.
Hold on. Can we just, and we can talk about it in recess, but we have a fresh batch of monthly candles waiting for us at the end of today. No big deal.
There's going to be some pretty ones. There's going to be some pretty ones in tech and growth.
Are there going to be some ugly ones elsewhere?
Yeah, because all the value sectors have pretty much been falling all month, right?
Have you peaked? Have you peaked yet?
I haven't peaked at the value ones.
I haven't peaked at anything yet.
I mean, we had some wild weekly candles last week.
Yeah, I mean, listen, I have an idea of what these candlesticks are going to look like, but I look forward to diving in. There's no basketball on tonight. It's on tomorrow. So I have a nice quiet evening of charts, maybe, a nice glass of Bordeaux. I don't know. We'll see what happens. See what kind of mood I'm in.
Yeah, there's going to be some ugly monthlies in the value stuff. Oh, well.
All right, Spencer, give it to us. What are we doing?
We'll talk about the monthly candles tomorrow. In the meantime, let's go to state of the markets.
All right. So for me, I think that the rotation that we may or may not be seeing this summer should be front and center. We're looking at small caps really flirting with last summer's lows. Still, we're seeing financials flirting with last summer's lows. Still, and then we're seeing industrials not necessarily flirting with last summer's lows, but I have a funny feeling that the way the two up above are going to resolve, the one at the bottom is likely to resolve as well. And, the industrials really look like just a great representation of the overall market. Tech is what it is. Financials are what they are. But industrials are such a diversified group. To me, it's just such a great barometer for the overall health of the market. So do we get rotation into these areas or not? And people are like, well, we haven't gotten any rotation. And I want to be clear. It's not that we haven't gotten any rotation. It's that we haven't really gotten rotation this year. Why don't you go to the next chart to show what this year looks like on a sector performance basis. Spencer, can you throw up slide 4? There you go. So this is year to date. So you're looking at technology up 33%, communications up 30%, consumer discretionary up 18%. Let's talk about quickly what stocks those sectors represent. These are market cap weighted sector ETFs. So the XLK, think about half of that, almost half is Apple and Microsoft. The communications, the XLC, almost half of that is Google and Facebook. Because let's remember, Google and Facebook are not technology stocks. They're in the communications sector. And then, of course, consumer discretionary up almost 20%. Amazon represents a quarter of that index. So these are mega cap growth stocks that are leading the way, which I think has been well documented at this point. And then look down below, look at, a lot of the defensive areas like consumer staples and utilities and healthcare, really underperforming, energy underperforming, industrials down for the year, financials down slightly for the year as well. And then go to the last slide, slide 5. And then here we're looking at, we saw the sector performance year to date. And now here we're looking at the sector performance in the back half of last year. So on June 16th of 2022, that's when the new 52-week lows list peaked, right? That was the market bottom. And then things have gotten progressively better ever since. So this is the back half of last year. As you'll notice, communications were the worst performers in the back half of last year. Consumer discretionary and technology wasn't doing too well either. So it's not that we haven't seen sector rotation. It's just that we haven't seen sector rotation this year. We got sector rotation. In the back half of last year, everything was working except for the growth stocks, right? Everything else was already working. Now, this year, it's the exact opposite. It's really those mega cap growth stocks that are leading the way, and it's the others struggling. So I ask again, go back to that slide 3 there. I ask again, do we see the rotation into these underperforming areas? This is, go to the one with the Russell financials and industrials. Do we see the rotation back into these areas? Do we see it? So this chart to me is front and center. And then finally, and Strazza, I want you to chime in here. The Vanguard Extended Market Index. This is everything outside the S&P 500. Looks a lot like small caps. Really flirting with those former highs, right?
It's a broader market average. No large caps. So yeah, it does look a lot like the Russell, doesn't it?
It's a broader market average that excludes the most important stocks, right? Do I have that right?
Yeah, if you're in the S&P 500, you're not in this.
Right. So the S&P 500 are the best stocks, right? Literally, by definition, the best stocks. And so these are all the other ones that are not the best, right? So this is kind of like, these are the stocks looking for the lottery picks. They didn't make the playoffs, right? So, and in the NBA, everybody makes the playoffs, I feel like. So these are the other ones. These are like the San Antonio Spurs of the world, if you will.
But these indexes, they're so important, right? There's so much information in them. We don't trade them, but whether it's, the value line, the Russell 2000, this is a pretty damn good one, VXF here. It really gives you a good look at what everything else is doing, right? You're looking at market internals in a way.
Well, yeah. I mean, it looks like small caps. It looks like mid caps, right?
Yep.
That's what it looks like. It looks like anything that's not the S&P 500. That makes sense.
I think when you're talking about rotation and the need for rotation, what I'm hearing is these charts got to get off the lower bounds. That's what I want to see from rotation, right? These lagging groups, you just showed the triple pain. You see financials and the Russell down at these former highs. They got to rebound off these levels. Couldn't be a better time for them to catch rotation, but it's been a rough month or two for these value groups. And that's what's mostly in these indexes, right? Russell 2000, VXF, a lot of value, a lot of financials. That's why they look so similar.
Yeah, the value line index too, by the way, right? Like you mentioned, the value line index is more of the median stock. And that's what this looks like, right? They all kind of look the same. Small caps, mid caps, the value line, right?
And at the same time, like they're going to have to carry some weight eventually, because I was just looking at MGK, Mega Cap Growth Index. This thing hasn't had really a down week at all since early March. It's up every single week, more or less.
Which is not bearish, for the record.
No, but these things deserve a breather, and they're going to have to take one eventually. And what's the rest of the market going to look like when that happens?
Hold on. So you made a good point yesterday. We're chatting with Louis in our crypto meeting that we didn't even talk about crypto. If that's not information, I don't know what is. We did talk about the Bitcoin coming off the lows, but we were mostly talking about sector rotation because we can't help ourselves. And so why don't you make the point that you were making to me?
I mean, first of all, if we're talking about tech stocks, aren't we kind of talking about crypto in a way? So we were talking about tech.
I guess not, because crypto's not moving with tech. Crypto's moving with bonds.
Hasn't been. I think it plays some catch up here. Listen, what I worry about is growth and tech have been on a tear, right? They've done great for several months now. You're really seeing that momentum kind of accelerate to the upside in the best stocks. Meanwhile, the worst stocks have been lackluster at best, sideways at best. A lot of them have been lower over the same, short-term time frame. What happens if growth and tech and the market leaders need to cool off and hit a corrective phase? What do the worst groups look like? I'm not worried about some backing and filling and some corrective waves in the leaders, but does that put the laggards below key levels, right? Are the laggards going to violate these critical polarity zones on some corrective action? That's the biggest thing I'll be watching if and when it comes. And I think it's coming pretty much now. I think it started yesterday afternoon.
Hold on. Did you just say corrective waves?
Yeah. Yeah, the next
All
wave
right.
be a corrective wave.
All right. Is it of the Elliott variety?
No,
This
but
particular wave?
there are some nice like words and phrases that you pick up from reading these different technical subjects. I like
All right.
phase, corrective wave, whatever.
All right. Waves are for surfing, not for counting, is how I learned it.
Listen, I'm not counting any waves. And I
All
can't
right.
stop either.
Should we do some earnings? We got a couple good
I
ones.
think we should.
The juicy this morning.
We got a couple surfers on the team though.
Ian.
Patrick,
What about Louis? Does Louis surf?
Patrick messes around with the surfboards too.
That's cool.
You're like,
All right. I don't surf.
no. We know.
All right.
All right.
Louis was like, I got to stop talking through the bumpers. I just can't help myself.
I like how it cuts you off, right?
Okay.
Like we should, it's kind of like a shut up Strazza button,
You need a mute Strazza button, Spencer.
Yeah.
Big red one right on you.
I can mute you if you want, but I just choose not to. Okay. Disaster stock of the day, Advanced Auto Parts.
Advanced
Holy cow. AAP. First, let's get
Sold.
the earnings
Look at this
calendar up.
Down almost 30% on the week now. About 28%.
Down 30% on the week. How about down 30% on the morning?
On the morning.
Yeah, 28% right now pre-market. Woof. You know what's extra concerning about this one? And I hate this kind of stuff. We've talked about it on here before. Go look at its peers. Its competitors are doing great. They have some of the best stock charts you'll find. What the hell's wrong with these guys? Don't touch this thing with a 10-foot pole.
Well, the O'Reillys and the CarMaxes of the world are not going to be up this morning, I can tell you that. So here's the deal with Advanced Auto Parts. The numbers are up on the screen there. Earnings per share came in extremely light. Sales came in light, but that's not the story. The story is their guidance and their dividends. So their guidance, they cut it by 40%. That's a pretty dramatic guidance cut here. Their EPS outlook for the year was cut by 40%. They also cut their dividend by 83% from $1.50 a quarter to 25 cents.
Oh, Spencer, they're doing something significantly different than their peers. O'Reilly's not out here cutting guidance 40% and slashing their dividend. Look at O'Reilly's stock chart. I don't know what these guys are doing wrong, but I'm sure people who are following can see it. And yeah, you are getting like a sympathy sell-off in AutoZone and O'Reilly. Right now, AutoZone's down over 6% pre-market, looks like. But just look at the price structure of those charts versus AAP.
Sure.
Downward sloping 200-day moving averages versus very much upward sloping 200-day moving averages. The charts couldn't look any different.
Listen, this is a great example of a terrible company that the market was already pricing in.
Yep.
This is not a secret. This might be a secret to some investors. It's a secret to me, but I really don't care. I don't have a position, so it doesn't matter to me at all. So it's new information to me just how terrible this company is. But the market has already been pricing in what a bad. Remember, the market is a discounting mechanism. So this thing has been declining for a long time. And to Strazza's point, its peers, AutoZone, O'Reilly in particular, O'Reilly and AutoZone, just great. But Advanced Auto Parts, I mean, whatever it is that they're doing a terrible job. This thing looks like a zero. I mean, right?
Yeah, I have an Advanced Auto Parts across the street from me. I don't think I've ever been there. Oh,
I was gonna say, how often are you in there?
I went there shopping for car mats.
Who goes there? Seriously.
I don't know. I don't even know why we have one. Yeah.
You can't just use Amazon? Like, is that not the way it works in cars?
Listen, I want to use Amazon for most things. Some things you got to make sure they fit, though, right? I want to lay the mats in my car. I want to touch them.
I'm just not a car guy, I'm not a car guy.
Hey, I'm proud of you. All right.
I'm not a car guy, I'm not a watch guy. I'm not a car guy. I'm like a good food and good wine guy.
Me either. I'm still going back and forth on the Apple Watch because I don't like having things on me.
You don't need it. You don't need an Apple Watch. It's the last thing you need, dude.
No, well, I'll explain to you why.
Get your inner Perlman in you, and the inner Perlman tells you don't need the stupid watch.
There's all sorts of technologies. They're gonna force us all to wear one soon. I'm telling you, because
getting the chip. I'm doing the chip. When I can get the chip, I'm doing it.
Oh, you already had one.
No.
Wait, do you guys want to know my like smart device theory? It's that it's going to expand into houses. So we already have like smart
right.
home stuff now, but like there's going to come a time in I don't know, decade maybe where you'll be able to move into like an Apple home
Yeah.
or a Google home,
Agreed.
right? And the whole house is connected, right, to all the devices. It comes with devices already. Right?
Was it one of you guys complaining to me the other day? Oh no, my friends here have like a smartish home, and she was complaining that she couldn't turn the stove on or the oven on and preheat it from upstairs. I'm like, that's probably a safety quality control there. Like,
Okay.
Dude, well,
Yeah.
we have a formula maker, which by the way, if you guys are having kids, get the formula maker. This thing I didn't have one for the first kid. Now I have twins, so like now it's a need, not a want, right? So the formula maker is connected to the Wi-Fi, and you could make formula on your phone. I don't because it takes 2 seconds.
Yeah.
But you can, which I think is hilarious.
dude, it's gonna be more stuff like that, and they're gonna force us all to get them. I think our pets are gonna have them too. You're gonna put them on your babies. I'm gonna be putting them on my pets.
So the pets have them in the collar, so you can keep
Grandmas
track
are
of them
gonna
and
have 'em.
stuff.
I don't know.
All right, what else? Hewlett Packard.
Yeah, I see some questions in the chat. We'll get to those in a little bit. I promise. Yeah, let's do Hewlett Packard. Let's do HP. Oh, look at this,
Great
Fonz.
chart.
Look
Great
at
chart.
you.
Chart.
Fonzo coming in hot with the charts.
Ninja.
Fonzie.
This is it. That's it.
No.
Enough said.
Enough said. So this is the market as a discounting mechanism, pricing in the fact that whatever it is that Advanced Auto Parts is doing is terrible, particularly when you compare it to its competitors, and whatever it is that they've been doing is clearly working. So the bad news comes out in Advanced Auto Parts in the direction of the underlying trend and down another 30%. This is the exact opposite of NVIDIA, right? Great news in the direction of the underlying trend. Granted, NVIDIA's competitors aren't exactly declining. They're kind of going up too. So the divergence isn't the great comparison. But again, the news in NVIDIA last week in the direction of the underlying trend. The news here in Advanced Auto Parts in the direction of the underlying trend. We see this constantly.
I would even go so far as to say, I think in my experience, I can't prove this. I haven't done any work on it, but I don't need to because I look at enough stock charts. Earnings reactions tend to occur in the direction of the tactical trend. If you have the primary trend and the tactical trend agreeing, great. That's even better. But if the primary trend's down, tactical trend's up, it's more likely that the reaction will be up. It's really the short-term trend, I think. But yeah.
So Hewlett Packard Enterprise, which is different than Hewlett Packard. Do I have that right, guys?
Yes.
Yeah,
Hewlett HPE
cloud one.
Yeah, is the cloud company, the enterprise software, the B2B. HPQ is your
Hardware.
your printers, your copiers, et cetera, et cetera. Anyway,
That sounds like the bad version of it. Do I have that?
well, there's a reason they're separate. Put it that way. HPE, it was okay report. It was mixed. Okay,
HPQ doesn't look terrible.
No, because these legacy tech, think of HPQ as the legacy tech brand, like the HP that we all remember. Those stocks are doing okay. A lot of these legacy tech names. I just saw Oracle on our Under the Hood report the other day. Did you?
I did not
Yes,
see it
yes,
pop
I
up on
did.
the Under the Hood report, but that is interesting.
Nobody else is excited about Oracle?
No.
Nobody is ever excited about Oracle. But it listen, it's in the right space, right? It's acting well. It's making new all-time highs. There's nothing to not be excited about in Oracle, right? It's doing what it needs to do.
You know who gets excited about Oracle?
Shareholders?
Accountants get excited about Oracle. Accountants love
Why?
it. The best general ledger system ever. No one's ever come close. It's incredible.
The best general ledger system ever. Oh, I feel like I'm falling asleep just saying that.
That was their go-to business for a long time. All of these big Fortune 500 companies, they use Oracle's general ledger system. And it's excellent.
Nice.
Can't beat it.
Oh, Rolly in the house. All right. What's up, Rolly?
Dad talks Oracle all the time.
His dad is my uncle.
Oh, that's awesome.
Yeah.
Okay.
Yeah.
All right. The HPE chart. Let's bring that back up here.
He's an accountant. He's a CPA.
The earnings were mixed. The guidance was also mixed, frankly, because they gave some light guidance for the current quarter, but they gave some good guidance for the full year. So, riddle me that.
Well, I mean, this thing is a nice base, right? I mean, it's doing what it needs to do. I mean, this is a healthy consolidation. It hasn't broken out yet. Obviously, it's not breaking out today, down 8.5% pre-market. But I mean, give this thing time. I mean, it doesn't look terrible, but it needs time. I mean, where are we trading? We're trading at 14.20. We're nowhere near a breakout. Like this, let this thing continue to do its dance. Let it dance. Nothing to do here. It's a mess.
Mm-hmm.
All right, and then HPQ, the EPS was a beat. The sales came in a smidge light. The guidance was like perfectly in line with the estimates, like right at the mid range. So there you go.
And stock's down 6%, down to 29. Again, still in this consolidation. I mean, listen, if you're really looking at this, zoom out to those former highs. What are we looking at? $30? Is that about right? $30?
This one
31?
I like.
31?
31. I like this one more, right? Because I love defining my risk here at these .com bubble highs. Was it Micron that recently? No. What was the chart? Marvell gave a perfect retest of these .com bubble highs. Looked almost identical to this just a few weeks ago. Now ripping off that level. I love buying against the .com highs.
Yeah, I mean, when you have those circumstances, and if you go tech stock by tech stock, you go one by one, you're going to find some of these. And you're also going to find some that still haven't recovered above those highs.
Do we have the Marvell chart here somewhere?
It's in there.
No, the zoomed out one. I know we have the zoomed in base on slide 19. Hans, maybe drop in the long-term zoomed out showing Marvell against those .com bubble highs.
I got you. Someone here's ready. I got you. Look at slide 2 there, Spencer. Just grab that.
Yeah.
Yeah, there you go. You got it. You beat me to it. My chart's nicer. My chart's cleaner. Put it in slide 2. But it tells you the same thing, right?
How extended are some of these tech names though, JC? I mean, are there some that you would want to stay away from here tactically? Did you see some of those candles from yesterday?
Yeah, I mean, I'm looking for rotation. What are the bets that we've been making? We've been making bets on Caterpillar. We've been making bets on small caps. We've been making bets on some of the smaller growth stocks that are just now breaking out.
Yeah.
Right. So, I mean, think about our best trades off the top of my head, maybe Lennar also, but other than Lennar, our best trades have been Tesla, Google, and Meta.
Yeah.
In this year, those are our 3 best trades. What does that tell you about the overall market environment that we're in? So over the last couple of weeks, we haven't really been pushing those trades.
Yeah.
For obvious reasons, maybe not obvious to you, but they're relatively extended. So I'm looking for some of that rotation. And the state of the market segment earlier was, talking about how if this is a bull market, right? Because sector rotation is the lifeblood of a bull market. So that's what we're in. We're likely to see sector rotation soon. It doesn't mean that tech can't keep outperforming. It can.
Yep.
But we need to start seeing a bit in some of those other areas, like we did in the back half of last year. So it's not like we haven't seen any sector rotation. We just haven't seen sector rotation this year.
It started off great, like you've been making that point. The Dow kicked off this rally. People forget about that now because it's been a while. But we need to see it like ASAP.
The Dow's also the closest to all-time highs, right? Much closer than the Nasdaq. Keep that in mind.
That's the low volatility characteristic of that index versus the others, though.
Well, it had a more shallow decline. The Nasdaq got hit much harder, so the Dow had less making up to do.
Lower beta, lower vol, whatever.
And so not only did it have less of a decline on the way down, it also was one of the first ones to kick off the rally last summer.
Right.
So yeah. So now it's like, all right, do we see it again?
I want to point out something that you just mentioned, just kind of flew right by. You basically said we want to err in the direction that we do get that rotation. Why? Because of the environment that we know that we're in, right? Everything else is telling us this is a bull market, guys. So we have to kind of expect to get that rotation. If we don't, then I think that would be that's a little concerning. Very concerning, maybe. Because you would expect to get it. That would be a characteristic of a bull market for the weakest stocks to pick up the pace and play catch up. If they don't, then we have to start asking questions.
Yeah, agreed. And we start breaking down. That's evidence of a lack of rotation. It's evidence of downside expansion in breadth if those things were to occur. So yeah, front and center in both directions. Think about the bullish implications for the overall market if those areas start to catch a bid. And then think about the bearish implications for the overall market if those areas don't catch a bid. And the point that you were making last night, if the laggards start to break down and the extended leadership groups just correct, which would be perfectly normal, and all of that is happening at the same time, what does the overall market look like? I would argue that the S&P 500 is still stuck in this range, which I think we should probably show it. Here, I'm gonna throw up slide 2 there, Spencer, so that you can just so you can look at the S&P 500 where we currently are, still stuck in this range. Like, are we slightly above it? Maybe, possibly. We're right around that 4,200 level, 4,150, 4,200, 4,200 and change. It's been a mess for a year, and we're still in that. So if we were to break down and the leading groups start to correct, I mean, we're looking at S&P 500 down to 3,400 or so. That's what that looks like to me, or at least 3,600, something like that, but probably closer to 34.
Yeah, at least the pivot lows, right? Maybe the October lows. So
retest the COVID highs, right? At 3,400. Yeah.
So, everybody and their mother is looking at this level in the S&P 500 right now.
Which one in particular?
41, 4,200. This is what everybody's talking about. It is totally important. There's a confluence of interest here. We have price memory at this level, but be careful because it seems like too many eyes are on it. It can get shaky. You can see some whipsaw action there. I want to see the August highs for confirmation. That's when I'll say, okay, green light.
Hughes took out their August highs.
Yeah, I know. So that's the roadmap for the S&P. Let's do it though. Let's get it done.
Healthcare is the other one. Healthcare hitting the lowest level since March, hitting multi-month lows yesterday. The XLV. The XLV is 14% of the S&P 500. It's the second largest sector. It's also 20% of the Dow. So that underperformance out of healthcare. And the other thing that I'll point out, I actually have the chart with me. If you can believe that.
Casey, how much of that healthcare weakness is simply just the defensive unwind, right? We're seeing staples get hit, utilities get hit. Healthcare looks a lot like those charts right now. When I look beneath the surface, really pharmaceuticals driving this weakness, which is as defensive as healthcare, really gets, maybe along with the providers. So could that explain that price action?
Take a look at slide 2 there, Spencer. Take a look at this. This is the one that's really, really interesting to me.
Yeah,
when we talk about medical equipment, this is IHI, so it's the Medical Equipment and Device Index, which at the end of the day are technology stocks, hiding in the body of a healthcare. But what are we seeing, right? We're seeing these two sector ETFs trading tick for tick for a long, long time. And then more recently, you're seeing technology making new highs, new 52-week highs. And the medical equipment stocks are not. They're rolling over. They're acting like healthcare stocks now. They're not acting like they're not acting like technology. So, to me, is it part of the rotation out of defensive? I don't know. Like, technically, I guess, yes, you can include healthcare as part of the more defensive areas, but is it as defensive as something like consumer staples, low volatility, utilities? I would say no, but still leaning in that area. But this, to me, if there's anywhere in healthcare that should be doing well in an environment that technology is doing the best, it would be this, and it's not. Is there anything, by the way, Strazza, is there anything defensive about medical equipment?
No, these are tech stocks. Maybe they don't have enough AI exposure. I don't know, but this is a great chart. I got to give it to you. You still got it, buddy. Yeah. Wow. No, it's a divergence, and if you zoom in on IHI, right, it was a nice reversal pattern. It looked like the rest of these bases just a few weeks ago. It's since failed miserably. That's one that would have been nice if that held. Those new highs held, and they have not. So
let's bring in Singleton. Bring him over. Bring him over, Spencer.
Not yet. I am troubleshooting with Mike right now. So you guys keep doing your thing.
Should we take these questions?
Yeah, let's take some questions.
Yes, that's a good thought, actually. I wanted to get to those. So
good question.
Go for it.
All right. Is this a good time to enter TQQQ/UPRO?
I don't think
these sound like leveraged ETFs. Do I have that right?
I'm not even going to look at these things.
Hold on. I'll look at it. Hold on. UPRO is the Ultra S&P 500. So this is the double S&P 500. And then what was the other one?
QQ.
TQQQ. Is that the double NASDAQ?
Triple.
I mean, these are for day traders, right? Like, these are day trading devices, day trading, vehicles.
Yeah.
they reset every day. So if you're a day trader and you're looking for twice the leverage in the S&P 500 or the NASDAQ, then yeah, knock yourself out. For anything more than a day, these are just inefficient vehicles.
So
Right.
here's what I do when anybody asks me about these things. I will overlay them with the index or the benchmark that they're trying to replicate, right? And I didn't even overlay them. I just did a quick eye test looking at TQQQ and QQQ. One's above the August highs, as it should be, because it tracks the NASDAQ perfectly. That's the QQQ. And the other one's not above the August highs. You don't want to hold these things for any more than a couple days at a time. They're not going to they're not going to reflect the returns at the actual benchmark.
Yeah, just because one's up 10% over a quarter doesn't mean that the double is going to be up 20%. Chances are it's going to be up a lot less than that.
Yeah, that's right.
Maybe even down.
They're dangerous vehicles. It's not the kind of thing you want to buy.
It's not that they're dangerous. It's that people use them in ways that they shouldn't be used. Like they're trying to brush their teeth with like a knife. Like that doesn't work,
Listen,
did we figure it out, Spencer? Did we get Mike in? Are we good?
We do have Mike here. Yes, actually. So I know we have a couple questions. We'll save them for later. But we have Mike Singleton, senior analyst at Invictus Research.
Right.
We got his mic working. So let's get him on the show.
Let's do it.
Yo, Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Mike.
JC, thanks for having me.
Yeah, man. What's going on, my man?
Not too much. Enjoying the show.
Appreciate it. All right, let's get right into it. What's on your mind? What are you thinking about? It's what day is it today? Today's Wednesday. Holiday weekend's over. Just getting going in the summer. When you're talking markets, informally, let's say we're at a bar or something, having a beer, and the market, I was like, oh, how'd the market close today? What kind of conversation are we having? What are we talking about?
Well, I hate to repeat what you guys were just talking about, but I think everyone's looking at that 4,200 level on the S&P. And I think that sometimes it's boring when you just talk about the S&P 500 over and over again, but there's no doubt that's the level in focus.
So you think that it's the levels in the S&P 500 specifically, not so much the components and what they're doing? You're focused more on a specific level?
I think it's both. I think that most of the questions that I'm getting right now are disproportionately focused on the S&P.
And it's underperformance compared to the NASDAQ, or more so on an absolute basis?
Well, I just think everyone looks at the S&P and that's the market. And so people are wondering whether this is the beginning of a new bull market. And when they talk about bull markets, they're usually talking about bull markets in the S&P 500. I think
they're not talking about Denmark.
No, usually not. Well, to your point, I know you've been talking a lot about developed markets abroad, and that's clearly been a much better place to keep your money than the S&P 500 recently. We're U.S. focused at Invictus, so we're probably more focused on the S&P. Of course, the NASDAQ and NVIDIA and the big tech names that have been driving the Qs and the S&P are also a topic of conversation. It's really funny when the big names are performing well, everyone loses sight of the other, 3,000 tradable stocks in the U.S.
It's really amazing because when they're talking about the market, they're talking about the S&P. They're definitely not talking about the Russell 2000 either, right? Right. Well,
Stan Druckenmiller talks about the market internals. He says the best economist I know is the market internals, and when I look at the market internals, what I see is not particularly bullish.
Yeah.
Right. Small caps right at that 2018 high, right, where growth and inflation peaked last cycle. That's kind of an important level across assets. You've seen crude oil break down below that level. Crude's a really important asset. I have a hard time imagining a breakdown in crude as bullish for any of those other assets that are right at that level. So small caps, transports, financials. I'm giving away my bias a little bit here, but I think that crude is probably the leading indicator for this cycle. I think that's probably the first asset to break that level, and I think that there's probably quite a few more breakdowns to come.
What's driving the weakness this week, you think, or even today? Is it just this China factory data?
I haven't looked at the market yet today. I'd have to pull it up. What are you saying?
Crude's weak today, and I think there were some China numbers out this morning.
Yeah, I believe that makes sense. I think that there are a lot of headwinds to the market right now, and there have been. So first of all, economic growth has been slowing. That's one of since 2021, really. since Q1 of 2021. And I'm sure I don't need to tell you guys that a lot of important risk exposures sort of peaked in either absolute terms or in relative terms in Q1 of 2021. But growth was slowing from a very high level, right? Because it was the reopening reflation. And so it's taken the market a long time for that to sort of digest through to the headline indexes like the S&P 500. So, global growth slowing is a headwind for pretty much everything right now. Since October, we've seen some sort of central bank liquidity tailwinds.
Yeah.
The Treasury you guys probably don't care quite as much about this, but the Treasury General account drawing down puts downward pressure on rates. The expansion of the Fed's balance sheet in response to the regional banking crisis in March also puts downward pressure on rates. And a lot of that is sort of resolving now.
Mm-hmm.
And as that resolves, it puts upward pressure on rates and downward pressure on long duration assets. Obviously, the Qs haven't heard about this yet.
I want to throw up this chart quick. Throw up slide 2. Throw up slide 2 there.
Hold on, JC. That's a great point, Mike. We're looking at these tech stocks and these growth stocks with rates doing what they have over the past few weeks and saying, who's right here? What do you make of that? Because they've been moving in opposite directions, right?
Ultimately, I think yields are going to be right. Rates are going to be right.
Okay.
That said, this is probably the worst, most boring answer
Yeah.
about the Qs and what's going on with big tech right now. There's really no fundamental explanation that I can think of for why they're doing so well, right? Like I track the liquidity data and the economic data, and neither of those two drivers are adequate to explain what's going on right now. So I think all I can think of right now is sort of hype around AI.
Well,
and
hold on. Aren't forecasted future earnings far higher this week than they were just last week? Doesn't that explain it?
Maybe. I think if you look at the trend in earnings revisions and earnings surprises, though, over time it tends to track the growth cycle. And if you look at when it peaked out in 2021. So have there been some marginal upside surprises since February or something like that? Sure, but they're not. I wouldn't be
calling Nvidia marginal.
I think
that was a big individual beat. But if you look at the aggregate revision indexes, they've been rolling over for a while.
What do you think about this chart right here with interest rates and crude oil futures? They've been, in sync for quite some time. The 10-year yield's been consolidating sort of sideways above those former highs, and crude oil is not. To your earlier point, you said before that you think that the rates have it right. The bond market has it right. So
crude oil has it more right. I think that crude oil is a reflection of a very weak underlying global economy, and the 10-year right now, this turn up is a function of sort of technical dynamics that aren't going to drive a longer term trend. I think what would drive the 10-year higher is if there's no recession and the Fed continues to hike rates. And crude oil is saying, look, that's not going to happen, right? Crude oil is down like some 45% from its peak. Why might that happen? There's really only two explanations. There's only two things that drive the price of crude. There's supply and there's demand, right? And I think pretty much everyone knows that there's not a ton of new supply coming online, which suggests that crude oil is down because global demand is slow. And when global demand is slow, that generally precedes lower rates.
And what about copper? Throw up the next chart there, Spencer, on same thing here, slide 2. Same thing. What are you thinking there with copper? I mean, we're hitting literally down to the lows of the year, right, in copper.
Yeah, I think it goes down to 330 or even 315. I think you had a great short opportunity at 415 or 420. Right. But look, as Dr. Copper, right? Why does he have a doctorate in economics? Well, because he tends to trade on the growth cycle, just like crude does.
Oh, is copper a he now? We're using these pronouns for copper.
Well, what do you think copper should be?
I think copper's more of an it, than a he. No. I mean, listen. For me, it's very simple. Look at that former support, right? Look at that former support from 2021, early 2022, and that turned into resistance, right? You nailed it. At 415.
So
right. I mean, it's kind of in the middle of a range right now. So tactically, I don't know if I would be getting all in on shorting copper, but I think I'd be looking for opportunities to short as they arise.
So
what do you? Sorry, Strazza. Strazza hates it when I steal all the questions.
He doesn't shut up. So we have. Let's play devil's advocate. We have things like copper, transports, railroads, right? Mm-hmm. Really pro-cyclical groups that we want to be seeing do well for risk appetite purposes, trending very poorly. But I can also point out to you semiconductors and home builders and other very pro-cyclical risk-on groups that are trending great right now. So how do you weigh them all?
I love that you just went like this, because
Who does that remind you of, Mike?
It's got to be Frank Teixeira, right?
Yep.
So I think that whenever you're evaluating the markets and the economy, you're always trying to use a weight of the evidence approach. And no matter what part of the cycle that you're in, you're always going to find some counter evidence to whatever your thesis is. Yeah. And look, there's no doubt that semiconductors and home builders are outperforming, and they have been for a while. And that's counter evidence to the economic environment that I'm describing right now. So I think that their performance is very hard to explain, and I think it's inconsistent with the weight of the evidence. But look, it is what it is. And as thinking about this from the perspective of an investor or even a technician, I don't mind having positions in some of those stocks if the risk reward is very good. I wouldn't be sizing up these positions hugely, but when something is going right and you can't explain why, I think that sometimes that's an argument for having a little bit of exposure there.
Yeah.
To that point, what we're talking about this whole thing, for those who are unaware, Frank Teixeira, great technician, legend, the way he says it, he's like, on one hand, you've got this and this and that. And on the other hand, you've got this and that and that. And whichever one weighs more, we want to kind of lean in that direction. And then at the CMT symposium about a month ago, Gina Martin Adams from Bloomberg, she was at Wells Fargo for a long time at Bloomberg, was basically saying the exact same thing. She was up on a panel and she's like, we're seeing home construction, we're seeing semiconductors. This is before the semi squeeze over the last couple of weeks. We were already seeing strength in semiconductors, and home building and some of the other areas, are showing strength. Then you got the financials and some of these industrials that are struggling. So, really getting mixed signals there. So that seems to be, and I like your point, if the opportunity's there, despite any mixed signals, take the opportunity, right? Maybe don't overthink the intermarket analysis in this environment.
A lot of times we don't find out why until later, I think is what you're saying, right, Mike?
Right. Or maybe the later is unknowable. And I think that this also brings up one of the great benefits of technical analysis as a discipline can bring to anyone's investment strategy is no one's better at managing risk than technicians, right? So if you see a good risk reward setup, you can take it and you're not going to get your head ripped off if things go wrong, right?
But that's what I like about the Caterpillar trade that we just put on over the last couple of weeks. That's what I like about the small cap trade that we put on over the last couple of weeks. Yeah. We're betting on that rotation, but if the rotation doesn't come, we're going to know right away. We're going to know very soon.
That's exactly right. No, I think everyone could take that, and whether you're a technician or not, everyone could take that understanding of risk, and it would benefit anyone's process.
So what's nobody talking about? Because here you're talking about, I don't want to repeat what you guys just said. Everyone's asking about the S&P 500. What are people not asking you about?
Give us your hottest take.
Hottest take. It really depends. It depends on who I'm talking to, because I talk with some technicians and the technicians are looking at certain things. And then I talk with a lot of fundamental analysts and they're looking at other things.
I want to know what you think. Forget who you're talking to. I want to know what's on your mind. What are people not talking about?
Okay, so here's my most contrarian take, and it's a longer term perspective. So if you don't like it, you can just dismiss it as long term. Right now, everyone's talking about, or like a lot of analysts have been talking about sentiment, right? And everyone's bearish, and this is the most forecasted recession of all time. At Invictus, when I do my work and I go through all the numbers and I look at sentiment data, not very much of it is useful, and most of it tends to track price. And so I think when you're talking about the AAII data or the investors intelligence data, you might as well be looking at a momentum oscillator. I don't know that there's any real value add in looking at those things.
The NAAIM one looks just like the growth chart.
Right. Yeah, exactly. So I tend not to spend as much time on the sentiment data. I don't give that a lot of weight. I like to look at positioning data, and even within positioning data, not everything has the same amount of signal. So a lot of people look at the commitment of traders data. I've yet to see any really persuasive analysis on that. I think it's good to know, but it's not something that I would take a big risk based on.
But do you think these hedge funds that are the most short ever on the S&P futures, you think that, the argument is that they're hedging their long positions? You buy that?
I don't know. I mean, the futures only compose one part of the market. So I don't know if that's a reflection of other dynamics taking place elsewhere that I can't see.
So for example, if we had such extreme positioning in something like cocoa or sugar or a more pure futures market, you'd take that more seriously than something like the S&P futures, where there's so many different ways to get exposure to the stock market, not just those futures contracts. Is that what you mean?
That would be very logical to me. Yeah, it would. But I'll say I don't spend quite as much time on cocoa futures, but mostly because my clients aren't quite as into it. What I'll wrap up by saying is one of the best positioning measures that I like is the Fed flow of funds data on household equity ownership as a percent of financial assets. And the reason that I care about that is because it has a very close correlation with 10-year forward returns. And right now, positioning is 95th percentile according to that measure. So people have only owned more stocks as a percentage of their financial assets 5% of the time. And so what that implies is real annualized returns over the next 10 years of, call it, between 2 and 3%. So I hate to end on such a negative note, but that's something that I don't hear anyone talking about.
Negative for who? Who cares? If people didn't like it, they could shove it. I respect that. I like that.
JC, you're in that boat, you know.
In which boat?
The people that own financial assets.
Yeah, but I have the ability to short them. Like,
Yeah,
I don't care about what other people do and what bags they get left holding. That's their problem.
Okay.
JC is good at changing his mind.
Yeah. All right. Mike Singleton is senior analyst at Invictus Research. Mike, thanks for joining us as always.
Thanks, Mike. Come back soon.
Thanks for having me.
All right. It is 9:15, which means it is time for our segment where we talk to Kimmy Sokoloff and ask her what she's trading today. Let's find out.
Go refresh my call.
Hey.
Morning. What's going on? Hi.
All right. So market, you got the Dow down 113 points, NASDAQ down 40 basis points. Everything's down a little bit. Oil getting hit a little bit harder, coming back a little bit. Dollar kind of flat. Are we buying this? Or are we selling it?
I gotta tell you, I'm not quite sure what I want to do today. Some days I have a whole list. Like yesterday, Twilo was on my list, which I think I mentioned in the room yesterday.
Yes.
And we got lucky. It popped after hours. There was actually news on it. So it went as high as 66, but I had my sell order in from early in the day. I do like day plus extended at 64.40, and I got filled, which is fine by me. But at the same time, it ripped to like 66. I was like, whoops.
And this is a good example because Kimmy was coming in yesterday looking to maybe fade some of the strength, kind of like, right, you had a more of a, fade this strength sort of mentality, yet Twilio, you were looking at it from the long side. So Kimmy, you do a good job of sort of, I don't want to say dismissing your overall market approach, but kind of separating them is probably the better way. Like, you're like, okay, fine, I want to be fading the market and kind of thinking that way, but there's a long opportunity here and I'm going to take it either way, right? I like that.
Right. Oh, well, thank you. But, yesterday, so I was short AMD and Clack on Friday, and I added to those positions yesterday. It's very, like I said, shorting's very hard. I try to tell people, you don't have to follow me in these names. They're aggressive names. Be very careful. And I added to AMD yesterday at 130. I did a separate trade in Clack yesterday at 470 down to 455.65 or so. So add to my position. I still have my original positions. AMD, I did not cover. I'm still in it. So it's hard. Like, I'll say, hey, I'm adding. It's very hard to tell people to add if they're in the position. This costs capital. Sometimes, like trading a high price stock could be, a capital hogger. So, I just try to tell people, like, you don't want to short, don't short, stay out of it. It's very hard to tell people to add to positions. If they ask
So
me.
You're sticking with your short semis here.
Yes, I still am in them. Correct. Yes. Yesterday, so we did Twilo in the room. I did a quick short in Adobe in the room. What else did we do? I can't even remember. Today, I put my note Google. Google held up well. I did alert it in the room yesterday. It was moving. I'm going to watch PayPal here. See if it could really hold this like 62 level.
From the long side. Yeah. If PayPal's above that 60.5 area, like, you can get a real squeeze going. You can fill that gap in the 70s. Kimmy, I like that risk reward a lot. That's a great call on that PayPal. Getting back to the point that we've made multiple times on today's show about knowing that you're wrong quickly. This is a name that's gotten beat up. Like, this is one of the worst performing names in the world. I mean, just from, like, especially with a market cap of this size, or market cap it used to have, I should say. down to these lows. I mean, just wow. And
Well,
especially in
look
the
at look
space
at
that it's in.
Target. I mean, look at Target. I mean, all those companies, Bud Light. I mean, obviously we know the reason why they're down so much. I mean, but just look at them. That Target was at 160 like a week ago, and now it's at 133, right? So it's amazing. So that thing
All right,
dropped.
Kimmy Sokoloff a room where she's live trading the open every single day and through the open. She announces her trades and she has winners all the time, as we talk about on this show. If you want to get into Kimmy's room, it is exclusive. The best way to get there right now, just email the email address that's on the screen. It's questions@stockmarketmedia.com. Just do me a solid and put Kimmy somewhere in the subject so I know what the heck you're talking about. And we will tell you what it takes to get into the room with Kimmy. Kimmy?
Thank you.
always
Have a good
pleasure.
day, guys.
Keep
Good
up the
luck
good
today.
work, Kimmy.
Bye. Thanks.
Bye.
All right. Before I forget, before we get too far away from it, you want to go back to those questions from the chat from earlier?
We can take the dividend one now, and we'll take the short interest one in a little bit. We're preparing
All right.
something for that one.
Cool.
Well, Shoy has a comment about how forecasting returns is a waste of time. It might be a waste of time for you. For me, I think it helps put things into context. That's really what it's about. When certain events transpire, when certain things happen, how does the market tend to do moving forward? It doesn't mean that because of that one data point, you're automatically going to flip the book into whatever that might be or whatever the case may be. It's one data point. So I wouldn't say it's a waste of time. I would say that there's a place for it. It's not everything, but nothing is everything, right? Sentiment is not everything. Just because it's sell in May and go away doesn't mean we're literally going to sell in May and actually go away. We're not going anywhere, right? Like it's about putting things in context. I think that's really the bigger point.
Good point. Here's what it really does for me. It provides a baseline for the market's expectations. All these projections and these forecasts and these economic numbers and earnings forecasts, that's then what the market is expecting, right? And it's all about the actual news versus the expectation of that news, right? So you want to know where that expectation is because that's going to give you an idea of what the reaction is to the actual outcomes, right? Does that make sense?
Yeah, I mean, I think you said it right, like a baseline. I think that's a good way to put it, baseline.
I'm still thinking about what Mike just said. I can't disagree with him at all about a lot of this sentiment data. I think really the best sentiment information we have is often very difficult or impossible to quantify or measure and will feel or sound anecdotal. And I think for that reason, we stay away from talking about it a lot of times. You're getting text, your grandmother is saying things to you. That's great. No, listen, it really is. And it sounds funny to even say magazine covers. But that's some of the best of fund launches, fund closures.
Yeah.
Kind of stuff.
It's nothing. First of all, it's not perfect. Number one. Number two, I think that very few people on this planet do as much or as good sentiment work as us. I would put maybe a few others off the top of my head in our category with the amount of work that we do in sentiment. And even still, even with that, and I can confidently say that we do some of the best sentiment work on the planet. I can confidently say that. Yeah. Even still, where does it fall in terms of importance in our overall process? Like nowhere near the top, right? Like, not even in the top 10, right? Like, so think about it.
Yeah.
Just put that in perspective. We can confidently say we do some of the best sentiment work of all time, and it's not even that important to us. Like, so, put that into context, right? That's real.
I agree, JC. And also part of that conversation that I really enjoyed with Mike is that you and I were kind of talking about this, I think, personally off air the other day. Like, it's never going to be perfect, right? We have to operate in these environments of just incredible uncertainty. Sometimes there's more uncertainty, sometimes there's less uncertainty, but the puzzle pieces are never going to come together and fit perfect to paint you some pretty picture. Never, ever going to be that way.
And if you think everything is fitting perfectly, probably take the other side, maybe. Huh?
Oh, you did something wrong, right? Because it should never happen that way. And what does that do? It puts us in a position where we as analysts have to really use our brains and weigh the data appropriately. And that's the hardest part about what we do.
I was on a Twitter Spaces last night with Fahmy and VC Lund late night. You
dropped
dropped in. I saw you. And, one of the things that I was talking about, and I was giving a shout out to Annie Duke. Shout out Annie Duke. If you haven't read Annie Duke's books, go read Annie Duke's books. Thinking in Bets, fantastic book. Her more recent one, which I think is called like Making Better Decisions or something like that, is another great one. Thinking in bets, start with that one and go from there. One of the things she talks about is, and she's a World Series of Poker champion, right? And super smart and awesome. And she's like finishing up her PhD in psychology, the whole thing. Anyway, and she lives right by me too. I'm trying to hook up with her and go grab a cocktail. But nevertheless, one of the things she talks about is that in poker and in markets for that matter, we are making the best decisions we can make with the information that we have in front of us, knowing that it's incomplete information, right? We don't know what the other player's cards are. We don't know what the market is going to do next. We have the evidence. We have to weigh it all and then make the best decision that we can with that information, knowing that it's incomplete, right?
That's right. Yep. And again, would you say that's the hardest part about what we do? Everything else is easy. The hard part comes in when you got to weigh it all.
I mean, listen, I wouldn't say anything we do here is easy. I would say some things are less difficult than others. I like the fact that we like to keep it simple. I like the fact that we are always innovating. When we find, sort of, like the Hall of Famers, just a great example. This is something that maybe 5 years ago we weren't doing. Maybe we were doing it kind of like informally. Like the Hall of Famers are the largest 150 stocks in America, right? These are the biggest companies in America, or the largest 100 stocks in America. Is it 100 or 150? I think is it 100? Either way, these are the largest companies in the United States.
Yeah.
These are the ones that are moving markets. If you get these right, you're probably gonna get the overall market right. Also, it's great for trade ideas because these are liquid stocks that are moving. And it's an options trader's dream because all of them have liquid options. So there's so many benefits from the Hall of Famers report. And just a great example of sort of the innovation. We found something that added a lot of value that we weren't necessarily doing 5 years ago that we do now every week. And man, I love it. On Fridays when I'm looking at the Hall of Famers, like I said, there's always ideas from a weight of the evidence standpoint. These are the most important names. If you want to know where the market's going, probably should take a look at these. And then if you're an options trader, these all have liquid options.
Yep, I agree. JC, we got to talk about this dividend question. Let's take this.
Oh, I thought you were going with the hot corner because Uncle Warren's at it again.
No, we'll do the hot corner. We'll do it. I'll be quick today, but I thought this was a great question, Joe. We mentioned that some stocks with high dividends are not the best investments. JC, you were not on Spaces the other day, but we talked a lot about that. You know our position on this. How do you reconcile that view with a stock like Pepsi, McDonald's that have been monsters? Pepsi has not been a monster. If you chart Pepsi versus the S&P 500, you'll see what I'm talking about. A lot of these staple stocks, it's difficult for them to outperform. We're not looking at it on a total return basis, so it's not including the dividend there, which is an aspect of it. But overall, the stock tends to lag over the long run. We could show a chart. Pepsi SPY would show that. McDonald's, and Pepsi does pay above market dividend, right? McDonald's also pays a dividend yield higher than the market average. I think the S&P average right now is about 1.7%. McDonald's pays slightly over 2%, and they are a long-term leader, right? So I would say to you about McDonald's, they're simply an anomaly, right? This is a special stock. It leads over the long run, pays a above market dividend, shows leadership, always trending well. Great earnings reports all the time. I mean, they just do everything right. There are some special stocks like that. I would say McDonald's is one of them. Do you disagree, JC? You won't find many stocks like that you could say what I just said about McDonald's over long time frames.
Well, how much of a dividend does McDonald's pay? McDonald's pays a 2% dividend, 2.1%. I wouldn't say that's astronomical. I think my bigger point when it comes to these dividend stocks is that the way to make money in dividend stocks is not to buy the stocks with the biggest dividends where you're getting this 7-8% dividend in some stock that's gotten slaughtered.
And
the reason that the dividend is so high is because the stock has gotten slaughtered. In my experience and with all the work that we have done, the better way to approach dividend stock investing is to look to buy companies that raise their dividends every year. Yep. Right. And the yield might seem low, but that's only because the numerator keeps going up, right? Price keeps appreciating, but we're not gonna penalize a company because the stock keeps going up. That's a good thing where I come from.
These are both super consistent dividend growers. And listen, you make a good point. It's not the 2%, 2.5% dividend payers that we have to worry about. In fact, that's often a pretty sweet spot, right? 1 to 2.5% is kind of what you want to see. It's the 5, 6, 7% that you have to worry about, because what that's doing effectively, think about what dividend yield is. It's price divided by dividend yield. So it's telling you something about the market's expectation for that stock. It's telling you something about the stock's valuation. If the stock price gets hit and crushed, it might go from paying a 2.5%, 3% yield to a 6, 7, 8% yield. That's the market telling you they're not expecting to get that yield.
No,
right? So
you're not getting that dividend, and you're going to lose even more on the price itself. So you're getting whacked twice.
When you see too big of a premium over the market yield of 1.7%, that's telling you that the market is doubting that dividend payment coming fruition as stated, right? Boom. Same thing.
Can we talk about the hot corner? Can we talk about these filings? Hello, I'm surprised. I mean, here we are an hour into the show. We haven't even talked about it once. Come on.
Let's do it. Hot corner. Let's go.
Hot corner. So hot right now.
Occidental Petroleum. How much did he buy?
Let's see. I got the table right here. Let me throw it into the slide deck. He bought about $273 million worth, another 4.6 million shares.
So he owns now, Warren Buffett owns 34%. Do I have that right?
Yep. So that includes the warrants, which are slightly out of the money. So you're going to see different outlets and data providers quoting his ownership percentage a lot lower, right? Because they're not going to include those 80 million shares from the warrants. We are going to include them, because they're at a strike price of 59.62, and it keeps flipping from in to out of the money. So as long as this topping formation is not completing, I'm going to keep including the warrants in his ownership percentage. What do you think about that?
I mean, I don't see any reason why you wouldn't, right? Like, I mean, I could see why some of these other data providers, are sticking to shares because it's probably easier. But yeah, I mean, if he owns the warrants, I mean, you and I trade warrants pretty regularly. I would consider myself a shareholder of some capacity.
Listen, he's planning on those warrants being in the money. He's looking at this as if he owns a third of this company right now. That's it. So if you see it quoted at 24, 25, 26%, they're just not including the warrants. Just doing math differently here. So that one really stands out. Third purchase just this month, in the month of May. There you go, the Buffett line, right? Dangerously close. Still flirting with it. He keeps coming out and supporting it. Is it enough? At this point, he owns about, if you include the warrants, and we could do a projected cost basis on that, about 16, 17 billion worth. He's got a built-in gain of about 1 billion right now. So not bad, but also not great, right? Stock really is trading the same range that he's been buying it at for over a year now. So let's see.
Does he own more Oxy or more Chevron?
Let me check.
He owns Chevron too. So his exposure to energy is a combination of Chevron and Occidental Petroleum.
Let me see here. So Oxy, like I said, call it 18 billion in market value. Yeah, and Whale Wisdom is wrong. This is just so terrible. All these data providers just can't seem to get this information right. Chevron about 21 billion, so still owns more Chevron.
A little bit more, and when I say $5 billion, it's only a little bit more. But
yeah.
For Uncle Warren, he owns a little bit more Chevron than Oxy. But for all intents and purposes, you could pretty much say that Uncle Warren's energy exposure is split between Chevron and Oxy. That's probably safe. Yeah,
that's right. And based on, due to the sizes of the company, it's a far more significant investment for a company like Occidental. It comes out to like I said, about a third of the outstanding shares. Well, he's not even a 10% owner of Chevron, so we don't get that filing information as timely as we get the Oxy filing information, because you need to be a 10% owner to trigger that Form 4 filing requirement.
So Chevron's almost 300 billion. Occidental Petroleum's closer to 50 billion. So Chevron's 6 times the size.
Didn't Warren just say he was not looking to take over Oxy?
Yeah, right. At the annual shareholder meeting, he has no intention to take over the whole company.
Yeah, he likes the company and wants to be a shareholder. Yeah, he's not like, I guess he does buy, like he bought Burlington Northern, like he does buy companies outright. Man, I was looking at the list of the companies that they own, right? Because we always talk about their liquid portfolio, But when you look at their private portfolio and the amount of companies that they own outright, like it is insane. What a list.
I go, baby.
Yeah, Geico, whole bunch.
It's a lot.
So let's just shout out another couple honorable mentions here. So, famed biotech investor Alexander Denner of, I believe it's Sarissa Capital Management. Yep. He's got a big stake in this Innoviva. Got a Form 4 filing from him, about $2.6 million worth. That would be ticker symbol INVA. Interesting looking chart too. I don't hate it. Another one that stood out on today's list was Driven Brands, DRVN. We had a series of filings, 2 filings, both the CFO and CEO, and they combined for a little bit over $1 million. So all those really stand out from today's list.
And those are it's a $4 billion auto dealership, that Driven Brands out of Charlotte.
The chart looks terrible.
Well, it's their problem.
Maybe we come off the lower bounds here. All right. That's all I got.
All right, if you're wondering what that table was, it's the Hot Corner, which tracks all the biggest trades from hedge fund titans to DC politicians to activist investors, and it's delivered in your inbox every day for free. If you want to get the Hot Corner, it's very easy. Scan the QR code on the screen or click on the link in the description of this video on YouTube, right where it says the Hot Corner.
All the biggest, most significant insider transactions from Wall Street to Washington to the boardrooms themselves. That's it.
That's it.
Ooh, I like that. That was a nice little tagline there. I like that.
That was nifty.
All right, I want to do one more question too, because our short interest scan, we just ran it while we were live here. Woo, these stocks are moving again, JC. You see Carvana trying to get some.
I did. They're getting squeezed. What else stands out of the Carvana? Because that's had the short that's had high short interest coming into the year. One of the things I was talking about last night, as a matter of fact, is we came into the year looking for these short squeezes. A lot of these names super high short interest, and in January you got the monster squeeze in these growth stocks. What I didn't see coming was it continuing this long with this much resiliency and relative strength. That I didn't see coming, and so it's funny that you're bringing that up now. What else stands out?
So Carvana, 50% short interest. Beyond Meat, 43%. Novavax, 40%. Look, Mara is still on this list with a
40% short interest in the marathon.
Short interest? I mean, this is Marathon Digital Holdings. This is one of those Bitcoin miners. And guys, these bases don't look terrible in these Bitcoin stocks, whether it's MicroStrategy, Mara, Hut Mining doesn't look terrible. I kind of like this one for a squeeze. What's the days to cover on this? Only 1.2. It's because it's heavily traded.
The Mara, yeah, it's heavily traded.
Some others that stand out. Upstart, which I don't love. MicroStrategy is on there at 30%. Again, I think MicroStrategy is a great way to invest in Bitcoin right now. We've talked about this so many times.
By the way, the Upstart doesn't look terrible. Spencer, I'm going to throw that in here in slide 2. Just throw that Upstart chart. What's the short interest right now? It is on the Upstart
35%.
35%, 3.5 days to cover. It's not the end of the world there, but the short interest is definitely huge, and that's what it looks like right now. UPST. Are there stocks that are showing more relative strength? Sure, but I don't hate this. Right? You're seeing that bottoming process that we're seeing in so many charts. Upstart, this is a software stock, right? Do I have that right? UPST?
Yeah, they're one of those buy now, pay never companies.
Buy now, pay never. Okay, got it. Credit services. Yeah. $30, it seems like a good level to me. We're below that, so kind of take it easy. But if we're above 30, I think we can get to see a squeeze to 40. Hey. If we take out 40, we could see that gap filled, go all the way to 80. So I think there's opportunities there. And one thing that I want to reiterate, you want to throw it up the list of the short interest one more time. Just because it has high short interest, just because the short ratio is so high, the short ratio is the days to cover. How many days will it take to cover all of those shorts based on the average volume? Just because it has a high short ratio, just because it has a high short interest, doesn't mean that the stock's going to go up. All that means is that there's a built-in catalyst that if the stock starts going, it can really go much faster and much higher, quicker than something that doesn't have a short interest. Because what people fail to realize is that a short seller is promising to buy the stock. A short seller is a future buyer. A shareholder is only a future seller, right? So the short sellers have to buy it. So they're those natural buyers built in to the stock. It's the mechanics of the market. But like I said, just because it's a monster short interest, Silvergate was 80% short and it's a zero. So they were right on that, right? So just because there's a super high short interest doesn't mean the stock's going to go up, but it's a built-in catalyst so that if it does start to go up, it can move really fast. So think of it like that.
And listen, like we've talked about doing our our short interest scan regularly, and there's a reason why we don't. It's because there's a time and a place to buy these stocks. You basically want to throw them all on a watch list and see when they start moving. And when you start to get squeezes in some of these names with high short interest, then it tells you, let's look at some other ones, right? And you want to buy them in an environment where you're getting squeezes. I would take a look at this chart. DM, I just had it up. Is it DMRC? Look at DMRC. On earnings, this thing's basically doubled in the last month. So that's what a squeeze will look like if and when you get it. So to answer the question here, Carvana, yeah, I think it's interesting. You could take a look at it and maybe ride it higher for a nice squeeze. You want to know where you're out to and really have a clear level of interest that you're stopping yourself out on. Like I was in Silvergate a month before they went to zero. I barely lost any money. Trade went against me. You want to keep tight stops on these things for that reason.
I have a couple,
or use options.
I have a couple questions for you guys based on this. First is, would you say that these squeeze periods tend to happen in like frothier or later stage? No.
They happen.
No, not at all. They happen at the beginning of the year. Tech stocks were making new 52-week lows, and NASDAQ was the only area not participating, and they came in squeezing them hard into the beginning of the year.
It's more a function of the rotation. It's when the speculative stuff is catching a rotational bid. It could be the third inning. It could be again in the sixth inning, eighth inning of a bull market. You'll see it in different spots throughout, typically.
Yeah.
And my next question was like, who in their right mind is still short Carvana? The thing is down like 95%.
You could have said that about Silvergate too.
It has unwound a bit though. The
Sure.
a few months back in Carvana.
Sure, but like, what more do you want? You know what I mean?
Listen,
but all right,
right? But like I said, you could have said that about Silvergate. Like I agree. Like I wouldn't be short, right? And if I am, it'd be with a really tight stop. When I see short interest like that, like I'm not looking to short it.
Yep.
Like if you are and you're successful, good for you. Like I wasn't going to short Silvergate, for example. Yep. Like it went to zero without me. I'm looking at it from the long side. So when I see heavy short interest, I'm leaning to put on a long. Whether I do or not, that's to be decided. But I'm not going to pile on, to your point, Spencer, on something that's down 95% with a monster short interest. I'm not going to pile on to that short. I'm going to be looking at it from the other side. Whether I take the trade or not, we'll see. You know, am I right or wrong? We'll see. But that's sort of how I look at it, to your point.
All right.
But other people are going to do what they're going to do, and they don't have JC's objectives. They have different objectives.
That's true. Okay, let's talk about chart report quickly here, and then we got some other stuff on the list for today. Oh, and just with Strazza's shirt. Look at that.
That's right.
Boom.
All right, I have it open on my screen here. Let's bring it up. There it is. Chart of the day from Mike Zaccardi, who we have to get on the show at some point. Broadcom, which we've been discussing.
Yeah, we should bring him in.
Yep, we will. So there we go.
Can we just stick right there with the Avgo? Because I think that's an interesting place to start. We were just talking with Kimmy, and she's been looking, she has actually short positions in semiconductors. Monster reversal in Broadcom yesterday. And just because we get a monster reversal candlestick doesn't mean the price is going to completely reverse. When you go and see parabolic tops throughout history, they tend to look like what Broadcom did yesterday for sure. But just like in sentiment, where it's not perfect, just like in sentiment, where does sentiment fall in terms of priority, in terms of weighting? Where does a single candlestick fall in terms of importance? I would say not near the top, right, Strazza? Where do you put? How do you when you see a candlestick like this? What do you say?
Listen, it takes two, really. This means very little to me, right? You need that follow through candle, which it looks like we'll probably get today. I haven't looked at this thing yet. Let me take a peek.
Market opened 15 minutes ago. We don't know what we're going to get.
Yeah, we'll see. Listen, futures were not great this morning, but Avago's higher today. So this candle by itself means nothing to me. Go read Steve Nissan, candlestick charting. One candle by itself means close to nothing, right? It's setting up for a potential candlestick formation, but you need that follow through on day two. And the previous candles also matter. So in this context, this is not an inverted hammer in Avago. It's a shooting star. And that's due to the candles that come in front of it. That's how we know that. So, one candle by itself, very little. Need to see some follow through. Maybe we get it today. Maybe we don't.
Anything else stand out in the chart report? What'd you like, Spencer?
Nothing especially stood out to me yesterday. No, honestly. I mean, it's all good, to be clear. Like every chart, there's a reason that Pat takes the time that he does to do this, because every chart in here is worth looking at, which is why I look at this every day. But no one tweet or chart specifically.
I want to give it out to the quote of the day, that the stock market is human nature on parade. This was a quote by William O'Neill. Rest in peace. This is one of the OGs of technical analysis.
Yeah.
For those of you who don't know, my first lessons about technical analysis, I didn't even know what technical analysis was, came from William O'Neill, came from Investors Business Daily. So this is someone who had a huge influence on my career. I mean, I don't consider myself an O'Neill guy per se, like some other friends of ours, like a lot of other friends of ours, but still very influential in my career and my life for that matter, and has just made such a huge contribution to the field. Rest in peace, William O'Neill. Big shout out.
I'll just second that, JC. IBD was by far my favorite investing publication, growing up and earlier in my career. Check out this book if you haven't already, How to Make Money in Stocks. That's William O'Neill. It's an amazing book. It's really incredible. Fusion analysis. It's good stuff. Yeah. Did you see the article from the Wall Street Journal that I dropped in the research chat today? Because go back to Brian Shannon's from the chart report. Brian Shannon's chart report.
Sure.
Right. Because this is interesting. People are finally starting to talk about it. What a dead year it's been, right? It kind of, JC, you remember 2017? Look at, and now throw up slide 3 for me. This is just a clip from the Wall Street Journal article. Same thing, Brian, showing different ways to visualize it. I love this little dot plot calendar type thing. So basically up top, it's showing last year, and the red dots or the darker green dots are showing you days where the market moved 1 or 2 or 3% even. That would be the red, right? And then you look at this year, 2023, almost no red dots. Basically, that's just showing you all the days in each month. Each day is a dot. I think that's a really cool visualization, but kind of 2017-y price action. Is it a little 2017-ish to you?
2017 was a great year, Strazza.
That was the calmest year.
Hey.
Well, you got the volatility index down near new 52-week lows, right? Yeah. Just hovering down near lows. So the fact that we're not getting monster swings makes sense. Sort of the rule of thumb is, you take whatever the VIX is and you divide by 16, right? And that's going to give you the implied 1 day percentage move. So right now, you're looking at basically about a 1% move for the volatility index on a day for the S&P 500 on a daily basis. 1% swings. When the volatility index is in the 50s, right? Now you're looking at 3-4% moves on a day-to-day basis. We're nowhere near that, right? So what this chart implies, or what this chart shows, is it's just a different way to show that volatility has been low.
Yep. Sure.
Okay, real quick, want to mention that the charts we were showing before, the chart report, which we mentioned, which we talk about every single day, is a free daily note. Compiles the best charts and trading wisdom from around the world of finance. Use the link in the description or use the QR code on the screen right now to get the chart report every day in your inbox.
I'm still looking at this short list here. Rocket Mortgage is on the list. If they go to 0, I don't have to pay, right?
That's definitely how it works.
Isn't I think
Yeah.
somebody takes it over and then you owe them the money. Something
I'm
like
kidding.
that.
Did you see this bullish development in the chat, guys? I see Sean McLaughlin in here feeling risque on some miracles.
I know we got a meeting in an hour. I was actually just looking at the chart here. I'm gonna throw it up in the I'm gonna put it up. Throw up slide 2 there quickly, Spencer. This is what I'm looking at. We'll definitely be talking about it in our team meeting today, but this is how it's setting up. I mean, this is what it looks like. Your levels are very well defined. You know, I don't have my Bollinger Bands up, but when you look at the price action over the last 6 weeks or so in Marathon, I mean, it's like a Toiger. You know, looking like a resolution is happening soon. We're right near a flat 200-day moving average. We're literally right in between the range between 5 and 20. I mean, this is as nothing burger as it gets. What I don't like about it is if I, looking at this right now, I'd want to maybe sell the 20 calls, sell the 5 puts. But Sean's telling me that the implied volatility is very low. So maybe like a strangle or something. Sorry, not a strangle. By a straddle. Looking for a resolution one way or another. Maybe, I don't know. We'll talk about it in our meeting. I'm looking forward to that.
Listen, another one from the chat. I see comments about SoFi here, so I just want to mention it. What SoFi breaking out? Question mark. No, not yet, but I really like this one. I've been following the
stocks up 13% this morning.
Listen, this base looks like it's going to complete, and it is going to go. I would put this one, on a watch list. Buy that base breakout. Anthony Noto, former CFO of Twitter. I think he was like the founder or something. He's CEO of SoFi now. He's doing a great job. Awesome leadership. It's very clear. Explains everything on the conference calls. He's been talking a lot about like credit issues that maybe they're perceived to have, but sounds like they don't. And also, this guy's been out buying more stock than anybody pretty much since we started doing the hot corner early last year. Anthony Noto is just a consistent inside buyer, and I love to see that. I think this base does eventually go. What's the level? About $8. But yeah, I like this one. I've been watching it closely.
I mean, it looks just like PayPal. I'm gonna pull up the. I'm gonna show you guys this chart real quick. So we're looking at SoFi, and then we're looking at PayPal. Here, let me just
I will say that I'm a SoFi customer, and I'm
Really?
pretty happy. Yeah.
What do you do with them? Like, what do you even do?
They're my primary bank.
Wow, really?
Oh, no
Yeah,
shit.
yeah.
Should I open up an account just to kind of play around with it, you think?
Sure. Yeah. I will say I was like a little bit perturbed at how opening the account. I had some issues. Apparently it's not that hard, but for me it was difficult for some reason. I had some problems, but once I got the account open, everything's been great. So I'm pretty happy. I mean,
really high interest rates, right?
yeah, I'm getting what am I getting? 4.75, I think.
Yeah. Some of the highest on deposits.
Can you show that chart on slide 2 there?
You know what's funny? A lot of these non-traditional lenders, whether it's Apple or SoFi, or I think Robinhood launched something like this, they're coming out and they are paying the most competitive rates, while traditional lenders and banks are under pressure and not paying high deposits. You never saw this coming. I think it's very cool because of their cost structures and their balance sheets. They don't have a lot of these issues with unrealized losses like the traditional banks do. They're able to pay higher interest, and I think that's never would have guessed that.
Put up the next slide too, Spencer, just to zoom out a little bit longer so you could really see what's going on here. They're really, really moving together. Spencer, throw up slide 3. Yeah.
Sorry. There we go.
Look at that. So you could really see PayPal getting absolutely destroyed. And if these things are going to squeeze, they're most likely going to squeeze together. Yeah. So we were, talking with Kimmy this morning on a potential PayPal squeeze. I like PayPal long above 60. I know Sean's in the room. I'm interested in that name, Shawnee. We'll talk about that in our meeting today.
60. Why not like 67? I thought we talked about this.
You're saying long PayPal above 67?
Yeah, those pivot lows there.
Yeah, you know why? Because I'm looking at the May lows, right? So I'm looking at those former lows around 60, right? Like a much tighter stop instead of buying the breakout above, right? You feel me?
I don't know, set up like this, I want to buy in strength. I like it too. I would just play it differently.
Yeah, the 67. Strazza's right. Buying above that 67 puts us above last year's lows, right? So the squeeze could really get going above that. Strazza's right. I like it. I like PayPal long against 60, maybe adding to positions above 67. I don't hate that.
Yeah,
I don't hate that at all.
A stock like this that's been this weak over short and intermediate term time frames, you want it to prove itself to you before getting long, right? And I get that at 67, I think.
All right, recess. Let's go. Let's hit it.
I would just add that the volume in SoFi, it's cyclical, but it's at that point where it's going parabolic again. And every morning I come in and I look at the pre-market action, what's up, what's down, and SoFi has the heaviest pre-market volume pretty much every single day, right? For whatever reason.
Is this like a Wall Street bet stock or something?
I wouldn't quite go that far, but it's a very social, it's a very retail loved stock, put it that way.
It's spec tech. It's got 13% short interest, not crazy, but not nothing either. Oh, all right. Yeah.
Yep.
I see what you're talking about with the volume profile. It tends to happen around earnings, it seems.
Yep. Okay, let's do some recess.
Grilled clams. Grilled clams.
On the grill.
On the grill. Just throw them on the grill.
Yeah.
Open up on their own. If they don't open, don't eat them. If you've got a good fish market, they're 19 out of every 20 will open. Every now and then you get one that doesn't open. Don't eat it.
I always have a good handful that don't open. It always seems like too many.
Because you probably go to a shitty fish market. If you go to a good one, then
clams isn't a Florida Keys thing. They're not from here, right?
What is a Keys thing?
Yours come from up by you.
I honestly, I go to this Portuguese fish market. Next time I go, I'm gonna ask them where they come from. But I got to tell you, they are delicious. Just throw them right on there. I get like a mug, and then I mix like butter with like Italian seasoning and crushed red pepper and garlic, right, fresh garlic, and I mix it all up and I pour them into the clammers.
Butter,
and then finish it with lemon.
Yeah, lemon, sure.
No, I finish it with lemon. Strazza's got beef with lemons.
Lemon's a dirty fruit. Lime is just a much cleaner, crisper fruit.
So you're gonna put lime on your clams, not lemon?
Lemons they're like hairy too. They're all like they got the strands in it. It's not lime. Cut through a lime, then cut through a lemon. It's different. One's just a far cleaner.
I agree. Listen, I agree. They're different. Don't get me wrong. I understand. Key lime pie. I love key lime pie. Listen, no beef with limes.
Yeah.
But when it comes to fish, right? When it comes to like a bronzino, for example, or in this case, clams, you're going to use limes? No, you're going to use a lemon.
Yeah. No, I would use lime.
Right.
I would use lime every time. Call me weird, whatever. What I will
Hold on. You're going to use a lime with your bronzino?
Yeah, absolutely. Really? Yes, that's how they cook down here too. You very rarely see a lemon. It's most
you're in the Keys, so limes are a thing down there, right?
Totally. Yeah. Listen, New England, nobody does shellfish like New England. I mean, tri-state, New England, up north there, like that's the move. Whether it's oysters, mussels, clams, like that's the best seafood from where I'm from, in my opinion. It's the shellfish.
Agreed. Strazza, you got anything for recess?
Not really. What have I been doing? Have you watched Succession yet?
Yes, that was my recess. I finished it last night. Dare I say?
No spoiler alert. I haven't seen it. No spoiler alerts.
Sam, I don't put fruit in the beer ever. Never. I don't put fruit in the beer. No.
If I'm drinking a Corona, I'll throw a lime in there. Not that I'm ever drinking Coronas, but if I was, I'm okay with it.
I like a Corona. I like a nice Corona, just no lime.
Hold on, Spencer. Without any spoiler alerts, what are your thoughts?
Succession. JC, are you really going to watch it? Because you're super late to this.
I've seen the other I don't necessarily get pleasure in watching rich, crazy families falling apart like other people. Like, I don't know. Some people are like sick in the head and they just like love watching like rich, disastrous families. Like I don't get pleasure in that. So like I'm not really that anxious about it. Like I'll watch it because everybody says it's good.
Listen, there's been a trend in that direction lately. All the streaming companies with like this kill the rich theme, whether it's White Lotus, that Knives Out thing, they're just mocking and hating wealthy people in show after movie after show. So there's like a bubble in that little.
I can see that. I would just say with Succession, they absolutely stuck the landing. 10 out of 10, maybe the best series finale I've ever seen, or at least one of the best. It was fantastic. They stuck the landing.
Yeah.
It was great. It was
All
great.
right.
And you're
All
right, JC. Like the show is almost depressing after a while because you literally hate every single character. There are like no redeeming characteristics about any of them. They're all just really bad people, and it's just kind of interesting.
Macaulay Culkin's brother is hilarious, though.
So good, really
great.
Yep.
He was, he was Fuller in Home Alone, the one that used to always wet the bed, and because you're drinking too much Coke
and drinking the soda.
drinking too much soda. That was him. Isn't that funny?
Yes.
Can I just say the acting in that show, Spencer, as good as I've seen it in any show ever.
Yeah.
Kendall Roy, Jeremy Strong. I mean, that guy is a freak of an actor. That new guy, Madsen, I thought was excellent. Like you said, Kieran Culkin. Logan Roy was obviously a great.
And then the girl, the sister, she's like Australian or something. She has a very thick accent.
She's like British, I think. Sarah.
Nah, she's Australian. Yeah.
Yeah. She's Australian. So the fact that
Nah.
you wouldn't know hearing her, I mean, that's to me, that's so much talent. Like these are things that I'm not good at, so I have so much respect for it. You know?
Great show. They ended it on a high note for sure. It's over. It was a great run. Fantastic. If you haven't watched Succession, check it out. That's going to be our show for today, though. I want to thank our guests, Kimmy Sokoloff and also Mike Singleton. Thank you for watching. Thanks to everybody in the live chat on YouTube for all the questions and the comments. If you want to smash that like button while you're there, I'd appreciate that. And stay tuned for more shows coming today on Stock Market TV. We have What the Fick with Ian Cully at 11:30. Strazza is doing the Hot Corner at 1. We're doing Pardon the Price action today at 2 o'clock.
Busy day.
And Options Trade of the Week. It's Wednesday. I keep getting it's Wednesday. Options Trade of the Week at 3 o'clock with JC and Options Sean. All right. Have a great rest of your day. Happy trading. Good luck. Go make some money.
Adios.
Bye, buddy.
Run it. I can't take no loss. I don't even know what it costs. I hit the ground, then it go